Morning, everyone. Welcome to the morning market review. My name's Russell Shaw, I'm a senior market specialist at FXCM. My email address rshaw@fxcm.com. Today is Friday, it's the 12th of August, 2022. I'm not sure if you can hear, I seem to have picked up a little bit of bronchitis, which is going around my family. My turn now. So, yeah, sorry, I'm sounding a little bit croaky. Here's our high risk investment warning. I'm going to keep this on. I'm going to keep this on the screen for a few moments. Hey, Howard. Morning to you. Nice to have you on the webinar, as always. Okay, I'm going to bring up the market commentaries disclaimer next. And references, MarketScope 2.0, cnbc.com, and of course we'll look at TradingView as well. Yeah, thanks, Rob. So it started with my father. He's getting better. He passed it on to my mother. She's getting better. And I visited with my folks, and now I've got it. All right. All right, let's go through to the NBC article. Just before we get into the CNBC article, so we want to read the just the media, what the media is watching as the European markets start to open. There's breaking news. The breaking news is the UK economy has contracted in the second quarter as cost of living crisis bites. Now, I think that's a story that we need to keep our eye on. And I think that it's significant. The print actually came in better than expected, but it's still a contraction. And I tell you, I think it's an important story to watch is because the communication out of the Bank of England was inflation at 13% by year end, which is astounding. But not only the inflation, they've said there's going to be a protracted recession. So this is all sort of fitting together, and obviously we want to see if we can get a break to this pattern. But this is, I think, kind of the first bit of data that we just got to keep in mind and see how it progresses. With that, hey Anna, morning to you. With that said, let's go into the article. This is CNBC. The articles for the European Open, and the headline reads: European markets set for a muted open as uncertainty persists. European markets are set for a flat open as uncertainty returns, with investors charting the course for monetary policy and economic growth. I'm not sure what that last sentence actually means. The Pan-European Stock 600 closed Thursday session in mixed territory, with European stocks having been guided throughout the week mostly by key data points out of the US and a deluge of corporate earnings reports. The cautious trade follows a choppy session on Wall Street on Thursday that saw the Dow and S&P 500 close near flat after giving up a short-lived rally on the back of another positive inflation report that showed a monthly fall in producer prices. Stock futures stateside nudged slightly higher in early pre-market trade on Friday. Shares in the Asia Pacific also mixed on Friday, following strong gains in the previous session as investors digested Wednesday's cooler than expected US consumer price index reading. Japanese stocks were the outlier, surging on their return to trade after a public holiday. Investors in Europe will be watching a slew of economic data releases on Friday, including preliminary UK second quarter GDP. Okay, we've got July inflation prints out for France, Spain, and Italy, and Eurozone industrial production for June. Okay. What I'd like to do is go back to this chart, which I think is really our, it's the first link in our chain, sort of a cause and effect dynamic going on. And I think the cause really comes down to real rates. So this was very interesting in that the real rates drop over here. Okay, so this is an important point. What is this point? This is where CPI comes out. You can see that the real rates drop. The next point, so I've got NASDAQ underneath. You can see NASDAQ shoots up here. The interesting price action here is that this decline in real rates is actually supported by the market, and our real rates are actually higher. Okay, real rates are actually higher. Now I think that's telling us something, because we've had a slowdown in CPI, we've had a slowdown in PPI, but the real interest rates are still supported. Now, the second chart over here is NASDAQ. Now, NASDAQ hasn't had sort of volatile run. Okay, so something's off kilter there, because NASDAQ is very sensitive to rate movements. That's why I've used NASDAQ in this example. So the way that the growth market has behaved is an anomaly compared to how the real rate has behaved. And the takeaway from that, in my view, is that, well, that break in relationship, that anomalous movement that we see, that cannot be permanent, because there is a distinct relationship, mathematical relationship, in terms of the time value of money, right? So any sort of break in a relationship obviously means one of two things. Which one it means is the challenge, but it either means that the real rates have to come down, okay, or it means that the NASDAQ has to come down, or in other words, the break has to reestablish. And if we go through to a longer term kind of chart, you can see what I'm talking about. The inverse correlation here is just too distinct. It's too strong for a break to be really considered. Excuse me. The idea then is we go back to the weekly chart, and the weekly chart is now all important for us as traders. You know, how come? Because we're looking as if we might get that. It looks like we might get that third condition. What's the third condition? Well, it's got to take out the reference candles high. So the reference candle is this red circle. Why is it the reference candle? It's the lowest low in at least 3 candles. Condition 2, price has taken out the reference candles high. That we've got. Condition 3, well, we close above it. Without condition 3, we've got nothing. And what does this mean for us, again, as traders? So we're looking at it in terms of analysts, okay? Trading, being a trader and an analyst, whilst there is overlap, are two distinct disciplines, okay? The analyst always tries to be right. Trader tries to make money. So that's an important distinction. So we've got a movement up here. We've got a movement down here, inverse relationship. We've got a movement down here. We've got a movement up here, inverse relationship. So now the idea is, well, do we get condition 3? Okay, this is a question mark. I don't know if we get it. We haven't got condition 3 yet. But if we do, well, then it seems that this leg here is a head fake, right? Seems like this is still a correction. Now, that's obviously an assumption, it's a hypothesis. We might get real rates moving back down like that. If we get real rates moving back down like that, then of course that will support the NASDAQ. But the idea here is we're at a very important part of the market price development. So we want to keep an eye on this. Now, I just want to go back to the hourly here. So how does this help us as traders? So I actually took a short position. I closed the short position, but I took a short position in euro. So if I just change this, so it was more kind of a very sort of quick, not really a scalp, we'll call it a day trade, because I closed it when I woke up. Yeah, so I actually went short euro here, because I just saw that there was this kind of positive movement here. Positive movement here. But that doesn't look right. There should be an inverse movement here, okay, because we've got an inverse correlation. So I went short, and then I'm just trying to. My thinking was then this little candle over here just starting to hit resistance. So I thought, right, I made a few pips. I'm just going to close it up, and I'll keep monitoring. But again, if we do get some sort of bullishness on real rates here, I think that's dollar supportive. I think that is negative for risky assets such as stocks. The big issue, of course, is why is real rates acting like that? Because we've got that moderation in inflation. And I think that's a conundrum that we're going to have to deal with over the next few weeks, over the coming weeks. Just off the top of my mind, the logical sort of answer to that is quantitative tightening. In other words, the QT is still going to tighten up the market. That would be interest rate, real interest rate supportive, one would expect. So this kind of movement in real rates really bothered me yesterday. There was an article I wrote, I did put it on Telegram, and the article was titled "The Peculiar Movement of Rates Making NASDAQ Analysis Very Difficult." And I think that's still the case. So let's just bring up NASDAQ once more, and then we'll start looking at a few other charts. So here is the NASDAQ coming down. That makes sense. That makes sense. Here is the drop in the real rate. Here's NASDAQ finding some sort of support. That makes sense. Now I just want to see where real rates go, right? And that would line up with the time value of money calculation, which we did yesterday. All right, let's take a look at a couple of other charts. Let's go through the DAX. I want to change this to our main layout. All right, so again, just to reiterate, the markets are much more difficult now, in my view, because there does seem to be some sort of rolling over in that inflation. Everything was kind of fitting together. High inflation, quantitative tightening, aggressive Fed, kind of made things almost one-way traffic. Now that's starting to fragment, and that's obviously making it much more difficult. So we just go back to technical analysis here in terms of trend analysis. We're still in a downtrend here on the, let's just put this to the DAX. I'm looking at gold, I beg your pardon. We're still in a downtrend here on the DAX. We've got a peak, trough, low peak, lower trough. Once you've got lower peak, lower trough, that's the definition of downtrend. We're on the weekly time frame, so we're looking at primary trend. We've previously drawn in the 62% retracement. That's this line here. Again, I don't think Fibonacci's have any mystical power to them at all. What I do think is that they are very closely watched levels by market participants, which makes them self-fulfilling. So the 62% here is now proving to be a key level. It stopped the advance last week, because we're looking at the weekly chart. It stopped the advance this week. I want to just keep an eye on that, because if this is a lower peak, then the permutations would be either a lower trough. That would be the first sort of permutation. The second permutation would be a pullback to a higher trough. So my system is just hanging at the moment because the cash open is just open. So we've got there we go. Okay, so the first permutation would be the lower trough. Sorry, it's still hanging. Second permutation would be the higher trough. And if we get that second permutation, possibly a higher peak. Otherwise, the third permutation is a sideways movement. So, you know, take your pick. You've got three outcomes here, which of course is uncertainty. Uncertainty is risk. Risk is what trading is all about. So how do we deal with that? Well, I think that the way that we deal with that is we keep the current definition until proven otherwise. What's the current definition? Downtrend, lower peak, lower trough. Lower peak at the 62%. We want to just keep an eye on that. Okay. Now, with this leg over here, which may be a bear market rally, it may not. Okay. If it's a bear market rally, it's going to be tricky because you go down to the daily chart. The daily chart's looking positive, isn't it? Daily chart's in zone 1, and if we're trading in zone 1, okay, it would seem that the current sentiment is up. Well, the current sentiment is up because of this leg here. And as traders, can we take advantage of the current sentiment? We go down to the hourly chart here, and do have a positive cross with our exponential moving averages. We do have a positive cross with our momentum indicator. So there's the triggers, right? Now, does that mean that there's going to be a successful trade here? No, it doesn't mean that at all. It means that if you choose to take these triggers, you need the stochastic to make it to the upper quintile. If it doesn't make it to the upper quintile, this is not going to, there's not going to be a swing. So you can see that the this movement here, it moves into the upper quintile, got a nice swing there. So this is a conundrum, right? Because we've got actually a downtrend on the primary trend. We've got a different reading on our daily that makes for difficult trading. We like the daily to sync up with the weekly. That makes life so much easier for us. We don't have that now. Okay, so remember, there's a difference between being an analyst and a trader. Analyst, you have to be right. Trader, you have to make money, right? It's a very different discipline. So there is a crossover here. Here's a crossover here. It's all about making its way through to the upper quintile. How does that tie in with our real rate? Well, I think that just using US real rates as a proxy, if real rates continue to move up, I actually think that is a drag on global stock markets. Risk markets themselves become less appealing because real rates are moving up. So what would typically happen is there'll be a rotation of capital into a real return, which of course may be one of the reasons why we've got a 62% retracement as a key level. The truth is we have got the bullish cross. Okay, Is it going to reach the 80 level and hold? I don't know, but it must do that for the swing to be successful. I want to just go down to Euro US dollar, see what's happening on that. All right. So here we've got again. Let's take these out. Let's just take these out. And here you can see that we've got a downtrend on our euro. We've got a ambiguity here because whilst the weekly chart is in a downtrend, we've got our euro in our zone 1. What I can say about this is there is a fair amount of resistance here. So there does seem to be overhead resistance, which seems to kind of supportive of the downtrend. And taking a look here, here's the breakdown. Okay. Here we are in the lower quintile. Okay, so if we maintain in the lower quintile, okay, we catch the swing. All right, so this is now again an ambiguity. So the euro looks like it's going down. Well, that would give strength to the US dollar. Why would there be strength to the US dollar? Well, in my estimate, the strength to the US dollar coming from the real rates. But if real rates are moving up, then I think the strength in the Nasdaq has to be questioned. And I think the strength in the Nasdaq has to be questioned, which is odd because it's starting off really strong. But just bear in mind that the real rates do seem to be on the move. Anna's asking, by the time it hits the upper quintile, is it too late to enter the trade? So the answer to that is, of course, let me think about it. Well, I'm going to say the answer to that is no. And the reason that the answer to that is no is because without the momentum building over here, there is going to be much of a swing. So you might miss sorry, I'm just pondering. All right, sorry. I think I've got an adequate answer for you, Anna. So the idea here is we're not using the upper quintile as the signal. Okay, so let me just go over the question again. By the time it hits the upper quintile, is it too late to enter the trade? That's not the signal. Okay, the signal is the dual signal on the EMAs and the stochastic. Well, we've got that signal, and we've got it way below the upper quintile. But I can say that you're not going to get any, you're not going to points under your belt unless we hit the upper quintile and hang out in that direction. Okay, so the upper quintile is all about measuring the underlying momentum. We are using a slow stochastic, so yes, there will be a lag there. Okay, there will be a lag there. So I'm just coming back to this, but I would just be very careful here. This R1 level probably, I would suspect probably is a level to watch. I think this is a key level. If we move above it, then we have moved up a quintile, I would think, then sort of game on for longs. But that real rate seems to be, I don't know, just a sort of a thorn in the side. I'm referring about risk reward. Just explain that to me. Just I can't remember what I said about risk reward. I think that the whole idea is, so let's just understand what we're trying to do here. We're trying to do a top-down analysis, and we're trying to line up all time frames with the primary, because that's going to give us I think that's going to give us the ultimate strength of direction. What we have now is an ambiguous situation. So right now, it's a high risk situation because an ambiguity between daily and weekly, we don't have the synchronization. So it is a high risk. Given that it's high risk, okay, we want obviously the market momentum to work in our favor. And that's only going to happen when we hit 80 and hold. If we hit 80 and fall out, it's no good. Okay, so here kind of hits 80 and falls out. It's no good. There's no swing there. There's no money to be made. Okay, here it hits and it holds. There's money to be made. If it hits 80 and falls out, it's no good. There's no money to be made. Once the swing is underway, it skews the maths. Once the swing is underway, it skews the. Yes. But so you've got to make peace, obviously, with your approach. So yeah, I've always said that once the swing is underway, it's going to skew your maths. But that's not the only thing I've said, right? I've also said we're not going to get in at the beginning and we're not going to get out at the end, right? So if we are okay with getting in sort of over here, well, we don't know. If I say to you, if I say to you, let's get in here. Okay, let's get in here. Now, the obvious question is, well, is the swing underway? Well, yes, it's underway. Has it reached its apex? I have no idea. Nobody has any idea. That's what trading is. Trading is assuming risk. Okay, so we put in a stop loss because we don't know if we're going to reverse here or not. Now, if it reverses, we get stopped out. Nature of trading. Okay, if it carries on going, we're making some good money. Now, what happens if we are over here? Okay, are we near the apex? I don't know. Nobody knows. What I can say is we're closer to the apex on the on this ellipse than we are on this ellipse. Okay, so I don't know. We don't know where the apex is, but I would say that the risk of being closer to the apex is higher on the second ellipse. So the way you've got to approach the market is a way that makes sense to you. But remember, there's very, very many ways to approach the market. My preferred is to come in later and to exit later. That's just my preferred method. So yeah, you know, we came a little later over here, fine, okay, but I'll take it because if it builds a position in the upper quintile, that's where you can make your money. So I guess that's the explanation. That you're never going to time it exactly. The crossover that we have here on the DAX, pretty early actually. We've got a crossover here, we've got a crossover here. We're not late at all. Is this going to work out? I have absolutely no idea. Nobody has any idea if that's going to work out. What that's effectively akin to is it's taking a position here. You know, are we going to fall here? I don't know. Are we going to move up here? I don't know. But that's what trading is. Trading is about assuming that risk of uncertainty. But in assuming that risk of uncertainty, you must have a stop loss and money management. So we need measures of momentum. We need entry techniques. Okay. What I'm saying, we've got the entry technique here. So if you want to enter, you've got the signals. Is this going to be a successful trade? Well, I don't know. It all depends if the momentum reaches the 80 and holds. Okay. And the fact that the real interest rates is moving up has me a little concerned that that's probably a hard ask given that we've got this resistance ahead. So I'm hoping that kind of answers the question. What we're trying to do is we're not trying to time exactly. I think that timing the market is an extremely sort of difficult ask. To try and make it completely perfect, I think is going to actually sort of defeat the objective. We want to approach it in a way that makes sense to us. What that means also, by the way, is that one person's method might not work for another person. We all got very, very individual trading psyches and trading psychologies. So the way that you approach the market must align with your particular trading psychology, because otherwise it's going to be too hard, too difficult, keeping sort of the checks and balances on a method that doesn't align with you. I hope that makes kind of, I hope that kind of answers the question, Anna. We also need angle and separation. Yeah, we need angle and separation. I would agree with that. I would, and Anna saying there's a lot of uncertainty with this trade, and I think there is a lot of uncertainty with this trade. But I think that the market right now, Anna, is uncertain. It's going to be very difficult to find a trade where there's not that heightened uncertainty. In fact, where there is a lot of uncertainty, we can go back to the let's go back to the US dollar. Okay, so this here is, to me, a completely new paradigm, and the new paradigm is dollar weakness, according to this chart. That's hard for me to make sense of on a lot of levels. Yeah, I can see it in terms of perhaps the aggressiveness of the Fed being less than it was a couple of weeks back, but quantitative tightening still a big bother to you. But despite, I think we've got this left shoulder here, head, and a right shoulder. Okay. And the thing about a head and shoulders pattern, forget about the pattern. Forget about the pattern. The pattern is a cute way of saying we've got a trend change. Okay, let's look at it a different way. We've got a reference peak. We've got a reference trough. Okay, we've got a lower peak. Guess what we've got here? Lower trough. Forget about the head and shoulder. Head and shoulders are always going to be present at trend reversals. They have to, by definition. Peak and trough analysis, right? So we've kind of got this change up in trend here, and that for me is quite a big change in the way I've been looking at the market. And now I'm trying to marry that head and shoulders with this this real rate. Something's off kilter here. Something's off kilter. Something's got to give. Either the dollar's going to give and go back up, or real rates have to give and go back down. But I don't know which one it's going to be, right? Guess what that is? Massive uncertainty. Massive uncertainty. So that's the environment we're in. So yeah, the ambiguity between the weekly and the daily time frame, I think at this particular stage makes a big deal, makes a big difference. Does this explain the anomaly in the Nasdaq? Yeah, so again, I'm a little bit confused about what's going on in terms of just general market dynamics. Why is the Nasdaq showing strength when the real rate showing sign of strength? Mathematically doesn't make sense. So something's got to give. Something's wrong here in terms of just basic mathematics. Okay, just basic mathematics is telling us right here. This is a high risk situation. Something's got to give. Which variable gives? That's the challenge. Now, I would say if the get that third condition, the Nasdaq's got to give. The Nasdaq's got to give. If we don't get condition 3, then I think real rates have to give. And so that's the conundrum. I don't have a cut and dry answer, except I can tell you what I think should give. And my answer is I think Nasdaq ultimately is going to give because of quantitative tightening. But of course, that's going to take a bit of time, I think, to discount in. So that's as about clear as I can make it, unfortunately, which is about as clear as mud, right? So we just kind of got to be savvy here. If you're going to trade, so if you want to take the bullish signal in the DAX, okay, so if you want to take a bullish signal in the DAX, I would understand why you want to take the bullish signal in the DAX. Is because there is certainly a kick up in our signals, but it means that you've got to be absolutely certain about with risk management. There's no gambling here. Okay, it's very, very risky, and we're running into this R1 level, and we still got this pickup in real rates. It's a bit odd for me. Now, what would be interesting is if we break R1, what happens to real rates? I would expect the real rates to be coming down. Then I think that the real rates would be coming down. Now, let's make one more point here. Let's make one more point. And I think the point is this. It's not bear markets that do the damage. It's bear market rallies that do the damage. Now, again, I don't know if this is a bear market rally. It may be the bottom. I haven't quite. I need more evidence. Personally, I need more evidence. I don't want to be sort of stuck in the mud and say, you know, this is a bear market rally for sure. But I do know that bear market rallies are exceptionally dangerous. You don't lose your money in a bear market. You lose all your money in a bear market rally. Okay, so we go back to let's see if we can find some examples in 2008. All right, so this over here may be an example. Okay, so we're looking at a weekly chart. We had 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 weeks before the capitulation. This one's not quite as long. Okay. This one over is probably a killer. Something like that. That was probably a killer. Yeah. So the idea here is just be very, very cognizant. Let's just take a look at Nasdaq. Let's go back to, and then we kind of bottom over here. By the way, let's just take a look before we look at Nasdaq. Before we look at Nasdaq, let's just look at Copoc indicator at this stage. So we're going back to 2009. What am I doing here? Sorry, I'm doing the wrong thing. Let's just go to DAX here. Yes, okay, and we want to go back to 2009. Okay, let's just get this guy. Let's quickly get this guy. Let's add in the POC, right? All right, let's just go back to 2008. And so I just want to go in here, and let's just add the 3-month EM as well. But so you can see over here we're late to, so we've missed the bottom, right? We missed the bottom, but it was pretty clear that if we didn't wait for the turn of the COPOC, we would have been caught in bear market rallies. So now we go sort of to sort of current environment, and the current environment, we haven't got turn up yet. So again, you know, that shows the difference between where we are now and where we were in 2008. I think the turn up here takes a lot of the uncertainty out. Let's just go through to NASDAQ over here. I just want to see some. Rob's just saying, from an investing perspective, I'm slowly scaling in with quality companies. From a trading perspective, I'm going fishing and enjoying the heat wave. Yeah, so from an investment point of view, I've got one left on the portfolio, Anglo-American, which is, I'll show you Anglo's holding a loss at the moment, but I'm thinking of scaling in. So you can see, I think I got in somewhere here, like right at the top. But everything else liquidate, so I'm just trying to perhaps scale in here, average down. Let's just go to NASDAQ. Let's just go to 2000, right? This is the tick. Correct. Let's make this logarithmic. Okay. So look here, we've got this. Where do we pick up here in terms of the COPOC? Okay, here. Actually, that's interesting. Still in the leg down, and then perhaps a second movement here. But let's just analyze this part over here. This is a bear market rally, right? 1, 2, 3 months of a bear market rally, and it actually hits quite early. This is interesting. That the COPOC here was moving up and price coming down. I guess just by way of explanation, the COPOC turn-up is not in of itself a signal, but as Rob says, probably, you know, a place to start looking for some quality companies. You really use that as tool one of your toolbox, right? You want to make sure that the COPOC's kind of picking the bottom. It did a better job here in the global financial crisis, and we just want to, I think, acknowledge, well, when you get caught in a bear market rally, sure, we could hit the bottom. Sure, I'd like to see the COPOC cross up. No? So it's okay. It's making for an intensely difficult market. Why is it making for an intensely difficult market? Exactly what we said yesterday. When we in the middle of what seems to be a transition phase. Now, what's going to be astounding, okay, is if it's not a transition phase, actually not a transition phase, then that's kind of almost vindication. If we kind of get another leg down, you know, then we're working with this when then we were battling for bear market rally while everyone else was calling for a bottom. That would be vindication. Of course, if this does turn out to be the bottom, then we again, and the whole point then is making peace with the fact that we're going to be late. Got to just accept that our tools are not going to hit the bottom spot on. Our tools are not going to hit the top spot on. But if we can get pretty close to the bottom, if we can get pretty close to the top, that's actually a 10 out of 10 for us, because that's kind of what we're aiming for. All right. Any questions? Please go ahead and type those through. All right. So I think what we'll do then is let's conclude at this point. Make peace with the fact we're in the middle of what seems to be either a bear market rally or a transition phase. The fact that it's a difficult market just makes sense in that case. And then we can reconvene on Monday and see if there's been any further developments. You guys have my email address if you need to email me. Thank you very much for joining me, and have a terrific week going forward. And looking forward to the Springboks doing a number on the All Blacks for a second week in a row. Cheers, guys.